Greetings, partners, and welcome to this presentation, which I hope finds you well wherever you may be. So I put this together because I'd like to share with you some of the material changes that have unfolded in your fund recently. We'll talk about the impetus for those, and we'll also discuss the implications in terms of performance expectations moving forward. I'd also like to discuss live performance as we move through the presentation here. I'm going to zero in on some of the challenging performance that we've had to endure as a group, which now unfortunately includes last month. So I'm going to provide some perspective and context there for you, and then we'll touch on some interesting ongoing research in the background which promises to enhance performance at some future points, and then we'll end finally with a discussion surrounding the change that we've implemented in the way in which we apply our performance fee, which now strongly favors investors. So our title today, Unleashing Performance Through Robust Diversification. You'll come to learn in detail what that means as we move through the presentation. So to start, two significant changes in our relationship with our broker occurred since we launched in 2021. The first was the removal of a minimum commission, and the second was an increase in execution speed. Now, this removal of the minimum commission, in fact, has not been an easy thing to achieve, and it's been a contentious issue since the dawn of time. And here I'm really referencing the platforms that preceded the fund that many of you form part of. So back in 2013, I launched those, and we had to contend with minimums as high as $10 and even beyond. And then we got it down to $5 and then $3. And finally, off the back of the success of those platforms, growth in assets and order flow, the broker was willing to accept a minimum of $1. And it was only until recently, end of last year, pretty much midway through last year, that we were able to remove that. And this, as you'll see in a minute, was a large handicap in the way in which we conducted our research, but also, importantly, how we deployed our research in the marketplace. And then we increased execution speed from an order a second to 30 orders a second, which again is not an easy thing to achieve with a broker. It's a custom setup that is restricted to their preferred partners. And in fact, I believe at this stage, it's the fastest rate they offer. And so these two changes together have led now for the first time to your fund being able to deploy its strategies in full. So what do I mean by that? Well, let's start firstly with commissions, and we're going to model commission without a minimum and with a minimum. And we're going to model it across a variety of stock prices from $5 to $3.20, and then we'll track the commission, which is a cent per share in the US, on the y-axis here. Now, our negotiated rate when we started was 1 cent per share. So for every share you execute in the market, you're going to be charged 1 cent. We then negotiated that down to half a cent. So if you're going to model this for a $2,000 order without a minimum, you can see that you always expect to pay half a cent per share regardless of price. So that's obvious. If you introduce a minimum, something interesting happens. First, if you restrict your execution in low price stocks, so $5 and $10 for your $2,000 order, you're able to enjoy the negotiated rate, which is half a cent per share. But as the price increases, the number of shares you can buy decreases, and as a result, you start to dip below the minimum. And the minimum here is 200 shares, because half a cent times 200 gives us $1. So you start to dip below 200 shares, and as a result, your cent per share cost increases, so much so that for a $320 price stock, and there are many of those and beyond in the US, you end up paying 32 times the cost. So you'll end up paying 16 cents as opposed to half a cent. So a round ticket now costs you 32 cents. And if you're targeting short-term edges, as we do in the fund on an intraday basis, that will rule out a very large portion, number one, of the research you can conduct, and number two, it'll make it very difficult for any research you can deploy to overcome. You're now got to think of creative ways to ensure that this doesn't eat into your edge, because essentially the broker's commission now is starting to eat into the edge of the strategy as well. You could decide, of course, to send just 200 shares in every stock. And if you did that for $3.20, you'd need a minimum order size of $64,000. Now, for a very big billion-dollar fund, that probably wouldn't be a problem. But for our fund, it was a problem. So we constantly had to figure out ways to get around this and ensure that we weren't being, our edges weren't being too eroded by this constraint. And really, the implications here is all about diversification. So the number of positions you hold gets restricted because you have to have some minimum size. The number of strategies you trade gets restricted because you have to overcome minimum size, etc., etc. And diversification to us is really the cornerstone of our entire philosophy when it comes to designing systems in the market and deploying them. And the reason for that is we believe strongly in general implementation as opposed to specific implementation. And what I mean by that is if you think of mean reversion, which is largely where our funds are deployed, the general thesis there is when a stock sells off, market participants tend to overreact, so we buy the stock in the hope that there's a reversal. And if you think of building a system here and you want to implement a specific approach, there would just be one entry and one exit. And how you arrive with your one entry, one exit is probably through some modeling. You apply to past market data, you optimize it, might be a percentage drop or a unit of volatility. But regardless of that, you'll end up with some optimal entry point and some optimal exit point that worked really well in the past. And then you move forward in time and the inflection point becomes quite clear because you suddenly learn that markets are dynamic and non-stationary. And this optimal point in 10 years previously suddenly becomes suboptimal because the market decides to reverse here because central banks have intervened or reverse at a much deeper level. And the same applies to your exit. And you end up with performance that now starts to really deviate strongly from your tested performance. So this is not a good solution. A much better solution is a more general implementation. We just accept ahead of time that we don't know when the market will start its reversion, and we also don't know when the reversion or the reversal will end. So because of that, we'll have multiple entries all the way down and multiple exits. And the analogy here is that loose pants fits all. So we really want to ensure that whatever model we build works on the past, but also has enough margin forever to be able to be as applicable in the various forms that data will present itself going forward. So we don't want to overfit ourselves to the past. And this is the way to achieve that. Now, the problem with this is if you have 10 setup conditions, 10 entry conditions, and 10 exit conditions, that's really quite a small number on each side. You suddenly end up with 10 by 10 by 10, 1,000 permutations. And if each permutation is going to hold 40 positions in the market, you suddenly have an algorithm that can hold 40,000 positions. And this led then to the next challenge, which was technological in nature. So yes, it was exciting to have the removal of the dollar minimum. We could now deploy our strategies in full, but we quickly realized that we had this sort of explosion in permutations. It's exponential in nature. And of course, you need to be sensible about how many permutations you're going to trade, but you'll still push up against some very real constraints. The first is if you're only sending an order a second to the market and you need to send tens of thousands of orders to the market each day, you're going to find it takes hours and hours to get into the market. So that's not a great idea. So we need to increase the speed. And this is where we negotiated the increase from 1 order a second up to 30 orders a second. So we're configured for that. On our end, we then had to rebuild the execution engine to execute in parallel to remove as much latency as we could to ensure we got close to 30 orders a second. In addition to that, we found ways to consolidate the order flow. So we could take a large number of orders, say 20,000 for a day, and bring them down to a much smaller number. And with the faster execution rates, now suddenly everything for the first time became feasible. We could diversify in full because the dollar minimum was removed, and we could actually get the order flow into the marketplace. These changes now have taken effect in full in your fund, and we'll continue to research them and expand on them. The other interesting thing is that the type of research we can conduct now is greatly enhanced. So I believe through time, there will be many powerful additions to our existing strategy base. Now, if you think about where we were previously, we couldn't deploy our models in full. You end up with a situation where you have to choose where you ordinarily wouldn't. We knew we didn't want to be specific in our implementation and one entry and one exit, but we also knew we couldn't deploy the models in full. So you end up selecting from your algorithm at what points you would like to enter. And if your selections end up being unlucky, you could see performance deviate. And that truly is what explains most of our losses during 2022, especially June and the months that followed. So here's an example of an algorithm on the long side that we traded through 2022. It's just a broken down, simple version of it so you can get an understanding. But essentially each row here is a little permutation, and I've ranked them by compounded annual growth rate. So we've got large returns on top and the smaller returns down below. And if you look at the number of trades the large returns are completing, as much as 8,000, they start to whittle down to about 1,900. So what's happening here is these little permutations are getting in early on in the move, while these ones here are waiting for much deeper sell-off. So the average returns are often better lower down, but they just don't do as many trades, so the returns are somewhat muted. Now, if you can't trade all these permutations, which was always a desire, you've got to choose from them. And because we have a target return that we need to satisfy, by default, you end up choosing strategies that tend to generate quite high returns. So I've colored them here, the best and worst performing returns. And if you switch through a couple of years here, so let's do a bear market, 2001. So things moved around a bit there, but we had quite a few rank higher. And there's another one for you. Let's do 2008. You can see our selections still rank quite highly. What about 2011 was a tough year. Selections are good. 2019, still good. 2020, we got the pandemic. So let's have a look at that. You can see our selection stayed on top. 2021 also worked pretty well. And then the most remarkable thing happens in 2022, the only year in this whole test period, and that's the markets for you, the dynamic, non-stationary nature of the markets. It ends up that all the strategies that we weren't exposed to, that or had very little exposure to, ended up generating the greatest returns. In fact, some of the highest returns they've ever generated through this test period. And that's true also for 2008. So reversions occurred at much deeper levels in these vicious bear markets. And if you look at the top two returning strategies that we chose to trade, some of them had their first losing years, and many had low single-digit returns. So the problem here is we were too specific in our implementation. And because we still saw strong returns in 2008 from the selection and other bear markets, I ran with that decision. It ended up being the wrong decision. Had we been general, and by general I mean we traded all the permutation, we end up with the return series below, which is simply an average of all the permutations. And suddenly you get a return on the long side. This is just a long strategy of 18%. Really very different to what we realized. And if you include the shorts, you suddenly have a return of between 40 and 50%. So this largely explains some of the difficulties we encountered in our first full year of performance. These have now been resolved. And I believe going forward, we're far more robust and resilient than previously. Now, let's have a look at the improvements in performance here. I'm going to contrast the previous portfolio with the new portfolio, which now we're hoping to see great improvements in the risk-adjusted metrics. So these are with all the full diversification, many more positions. In fact, diversification now increases on the position side by as much as 3 times in some instances, by including many more permutations, and then also allowing our risk scaling algorithms to operate in full, so that very risky stocks get a small number or a low allocation to offset the risk. Now, before we look at these are simulated results. Keep in mind, they're no guarantee of the future. In addition to that, they're after all broker fees, but before our performance fee. So you have to keep that in mind. And then there's always market impact. When we enter the market, our very presence can change the way of the dynamics of the market. So we need to keep that in mind as well. And we don't always get our trades. We miss trades, liquidity, short locates, etc. But a good rule of thumb here is that we hope to achieve at least half of the back-tested return. And if that's sufficient for our target return, then we're happy. So keeping that in mind, let's have a look here. These are the simulated results. We've got the before the evolution and after the evolution. Here we've got the compounded annual growth rate. Previously, we were at about 56%. We divide that by 2, you're getting somewhere around 28%. If you take off our performance fee, you're struggling to deliver on our target return. But that was the best we could do at that point in time. With the evolution, we've now got a return of 82%. So this is really a dramatic improvement from previously. And the 82%, if you divide, you get 41. If you take off our performance fee, suddenly you have a portfolio that now looking like it's got a strong possibility of delivering on our 25% target return. In addition to that, I've included drawdown. These stats I've included because I think they're most meaningful for investors. Return, risk, and then just a risk-adjusted stat. So Here we had the worst peak to trough loss was negative 16. That actually improved to negative 12 after the evolution. And then if you look at our risk-adjusted stat, which is the MAR ratio, which is simply the absolute value of drawdown divided into return, which tells us how many units of return, how much greater was the return relative to the drawdown. So we've got 3.5 units of return per unit of risk previously, and suddenly it shoots up to 6.5 times. These are already fantastic improvements, and what you hope to observe when you have an evolution of this nature. So I'm sharing these with you, but right across the board in terms of drawdown profile, the recoveries, not just from the worst drawdown, but drawdown in general, were improved. There were more consistent performance. Average trade returns improved. Risks adjusted stats relating to each of the trades improved. So largely, right across the board, we saw improvements both on the short end and the long end. And I really believe that we have a portfolio now that's far more resilient and robust due to these changes. Now, we need to keep in mind, I'd like to zero in on last month. Your fund generated return somewhat lower than negative 6%, I think negative 6.3 or thereabout. So I'd like to talk about that, because even with the most well-designed system, we're going to face losses, of course. We appreciate that, understand that, and it's par for the course. But you're also going to be faced with strategy-specific risks. Regardless of your approach in the market, there will be risks that are very specific to that approach. And because we're largely allocated to mean reversion, we'll talk about that risk. And in relation to mean reversion, there's a risk that we face, which is known as tail risk. And that is a risk that the trends that we are betting against simply do not reverse. They keep moving against us. And this is a well-known risk, and actually a risk that many funds and many approaches out there face in various forms. And tail risk can present itself in a number of ways. It can be market-wide, such as 1987 crash. It could be select few stocks on the short or long side, or it could be entire sector. And this is relevant because last month we had a banking crisis in the US, the third largest banking failure unfolded, and that had knock-on effects for numerous banks, which has resulted in a massive tail risk event. And it's because of that we faced the losses last month. And so when you're faced with these tail risk events, they're very difficult to navigate for our strategies. We can only hope that in these instances, our risk mitigation techniques are efficient enough to ensure that we don't fall down a black hole. So on a positive note, yes, a negative 6% return is difficult. And I know that it's been magnified by the fact that we are already in drawdown. But it does speak to our risk mitigation techniques working quite well and containing the risk from being a lot worse than it could. So let's just have a quick look at an example here. And I choose First Republic Bank because this stock was trading on average $200 million a day, which places it firmly in the top 500 liquid stocks in our universe. It's also pretty low vol. So by all accounts, before the crisis, this was a stock that we would have traded quite heavily. And our algorithms are backward looking. We don't try and predict the future movement of price. And so as it started to unfold at this point here, our algorithms would correctly have started placing bets with the hope that there was a reversal. And clearly there was no reversal because it's a tail risk event. Having said that, our intraday strategies did exceptionally well to profit from some of these moves on a couple of these days. So they recouped a lot of losses that were experienced from overnight strategy, which again is testament to more generalized implementation. We need to capture our edge on an intraday basis as well as across overnight holds. And so many of these losses were associated with these stocks that's collapsed essentially from $100 down to zero. And in fact, one such stock, Signature Bank, went bankrupt overnight, and we lost our entire stake there. So our risk mitigation worked well in this instance. And it's unfortunate in its timing, but it's important to keep in mind that these are truly the exception rather than the norm. We've been applying these models in the market on a full-time basis now for a decade across various markets. In fact, this is the very first time that we've ever been caught in a bankrupt stock in a live environment. We've deployed now literally millions of trades across various exchanges. So clearly we expected it would happen at some point, and we understood that tail risk exists in the market. We've worked very hard to mitigate it. But it is something that exists, and it's specific to our approach. And in fact, we almost need to embrace this risk in order to enjoy in the potential premium of deploying our approach in the marketplace. Now, we're actively always looking for ways to mitigate this, and we can touch on some of those briefly in a minute. And so just as a sort of summary here, 2022, we suffered a bit because we had these commission and technological handicappings. We've now resolved that. So are we presented with a similar sort of situation in future? We're going to be better prepared. And then we had strategy-specific tail risk, and that caused losses last month. And there's very little we can do about this type of risk. Yes, research is ongoing, but largely it's a risk that we need to embrace. And so in summary here, the research, we believe, has progressed materially, which is really why I wanted to get a presentation out here and share this with you. So we believe we're more robust, more resilient now. We're trading many more strategy permutations. We hold many more positions. Our risk management algorithms that scale to stock volatility, liquidity, and regime can be applied in full. And I think this bodes well for the future of your fund. And then finally, the research space has been expanded. There's very little that we can't do now. And so it's an exciting place to be, where we can start to explore numerous other ideas that may enhance our performance down the line. So just a quick recap. We had fund inception last year. We restricted the trade universe. There was a slight algo adaptation, but really 2023 is where the massive material change comes in to our deployment, to our diversification. We included some additional risk overlays. We haven't expanded universe, but that's something we're looking at doing in the near term. And these changes, just so you know, are expected and will continue to happen as we move through time. We hope not to make massive material changes all the time, but there will be adaptations as we move. And that's just staying true to the scientific method, which is really the basis for all human knowledge as we know today. So we build observations and hypotheses, we collect the data, test them, and then we deploy them. And we get feedback from the market, from a live environment. And that feedback is really, to me, some of the most important feedback you can have. It's very hard to conceive of all the risks you might face when you build your first model. But as you iterate through this process many times, which now we've done for almost a period of 10 years, you get incredible feedback, and that works into building a more robust and resilient approach. So yes, we are faced with some difficult performance to date. And I think for those that are new to the program, you will have questions, you'll be concerned, and that's really very normal. Others that have been with us for an extended period will know that we've been here before on more than one occasion, and we've risen to prosper again at some future point. But let me try to reassure you that we have obviously can't predict the future. We have no guarantees about the future, but we can tell you that since our launch in 2013, we've executed these models across many markets and built really a very sizable live database of historical trades. We've also got a very substantial, statistically significant simulated database. So at the very least, there's some evidence, strong evidence to suggest that what we do works. And so we've got 9 months of the year left, and I'm confident that we may well see a positive outcome. Very quickly here, so we discussed this tail risk that we can be presented with in our approach. And one way to mitigate that is just to simply have strategies that don't look for reversals, but instead try to latch onto trends. And if you have that and you can get that right, then you basically have two strategies that execute in almost mutually exclusive domains or price moves. And what you'll find is one offsets the risk largely of the other. We've made some very encouraging progress here, so much so that some of the strategies have been deployed live in production as a test in personal accounts, but we've had to pull them due to some of the execution that wasn't playing out the way we hoped. So we're back on the drawing board. But if we get this right, this is going to be a very powerful addition to your fund. And it's really where a lot of the energy and focus will reside for the course of the next year, because it introduces this incredible diversification. And because it capitalizes on trends where mean reversion fails on very big trends, they're a great coupling. So we'll keep you posted on that front. And then I'll just end very quickly here. We've decided to change our performance fee invoicing from quarterly to annually. So instead of being invoiced every 3 months in the fund, you'll be invoiced once a year. So essentially, there are no fees in the fund up until the end of each year. You pay no fees. And what that means for you as an investor, you get to trade or compound a proportionately higher pot. So the payoff here for you in a good year is a proportionately higher return. In years where returns aren't that great, and depending how the returns unfold through the year, generally you're favored compared with the previous approach. And this is just our way to display faith and conviction and ensure that our interests are always 100% aligned with our investors. So as always, I hope that I've provided some insight into your fund, the research that is ongoing. I hope I've been able to answer some questions you may have. I know it's a difficult time. It's at these points where it's important for us just to keep the communication lines open, and we stand ready at any point to meet on a one-on-one basis. If you have additional follow-up questions that you'd like to be answered, please don't hesitate to reach out. So thank you for listening. All the best, and we look forward to a strong finish in the year ahead. Cheers for now.